Hello, and welcome to AI Market News by LM. All right, let's jump right in because things are getting really interesting in the currency markets. The US dollar has just smashed through a critical level against the Japanese yen, and believe me, it's got traders and central bankers everywhere on the edge of their seats. And this is the number everyone is watching, 160. Now for the dollar-yen pair, this isn't just some random number. It's a huge psychological line in the sand. Every time we've got near this level, alarm bells start ringing, and this time is absolutely no different. It signals some serious pressure on the yen, and frankly, it puts Japan's financial authorities in a really tight spot. So that leads us to the million-dollar question, doesn't it? With the yen getting this weak, is the Japanese government actually going to step in and do something about it? Well, to figure that out, we first need to get a handle on the powerful forces that are shaking up the entire global market right now. First up, let's zoom out and look at the bigger picture. Because this isn't just a story about one currency. Nope, this is all happening inside a global market that is feeling some intense pressure from all sides. We're talking geopolitics, sky-high energy prices, and just a whole lot of investor fear. A huge piece of this puzzle is the ongoing conflict in the Middle East. With Brent crude oil, that's the global benchmark, hovering near $105 a barrel, you can bet the concerns about inflation are flaring up all over the world. And that, of course, puts central banks in a very tricky position. So how is all of this making people feel? Well, this slide gives us a fantastic snapshot at the market's mood. The Fear and Greed Index basically tells us if investors are feeling brave or if they're running for the hills. And in times like these, with all this risk and uncertainty, fear definitely takes over, and that pushes investors away from anything that looks even slightly risky. And we can see that exact sentiment playing out right here in the US stock markets. Take a look. The major indexes are all in the red. The Dow, the S&P 500, the tech-heavy NASDAQ, all of them are taking a hit. It's a pretty clear sign that investors are pulling back from stocks and looking for somewhere safer to put their money. So, if investors are ditching stocks, where is all that cash going? Well, that question takes us straight to the foreign exchange market, where one currency has been the standout winner in all of this chaos. It's a classic flight to safety move. Investors are piling into the US dollar. You know, when global uncertainty spikes, the dollar becomes the ultimate safe haven. It's not just a habit, it's because US financial markets are so incredibly deep and liquid, it's just the easiest and safest place to park huge amounts of money. And all that demand has pushed the dollar to its highest levels of the year. And let's be clear, this is not just a yen story. The dollar's strength is across the board. As we can see here, while it's trading near 159 against the yen, it's also seriously flexing its muscles against the euro. Understanding this widespread demand for the dollar is absolutely key to getting why Japan is in such a tough situation. And this is where it all comes to a head. All of these global pressures are converging on the Japanese yen, pushing it to a breaking point that could very well force the government's hand. And boom, here's the proof. We're getting direct comments from Japan's finance minister, basically putting the market on notice. When officials use phrases like high sense of urgency and ready to take bold steps, well, that's not subtle. That is a clear, blinking warning sign that intervention is a very real possibility. Now, looking at some data from Owanda, we can see that retail traders are already trying to get ahead of this. A big majority, we're talking over 66%, are shorting the dollar against the yen. What does that mean? They're betting that this is the peak and that the pair is about to fall. They're likely banking on an official intervention from Japan to make that happen. It's a bold move for sure, but it just goes to show you how much the market is expecting some kind of official response. So what happens next? That is the crucial question. The stage is set for an absolutely massive week. We have a calendar packed with economic data and, more importantly, a whole slate of major central bank meetings that could completely change the game. People are calling this a bumper week for monetary policy, and for good reason. More than 20 central banks are meeting. But we're really focused on the heavyweights, the US Federal Reserve, the Bank of Japan, and the European Central Bank. Their decisions this week are going to be so critical. First up, the US Fed. The market's expectation here is crystal clear. The CME's FedWatch tool is showing a 99.1% probability that the Fed is going to hold interest rates right where they are. So nobody's expecting a surprise move. Instead, all the focus is going to be on their tone and any clues they give about future policy, especially with those inflation risks bubbling up. Meanwhile, over in Europe, the European Central Bank is in its own tough spot. This chart from Bloomberg Economics shows that inflation in the euro area is expected to stay stuck at 2.5%, and that's mostly because of energy costs.
This puts a ton of pressure on the ECB to maybe take a more aggressive stance, possibly even hint at future rate hikes.
And it's not just about the central banks. We'll also be keeping a close eye on key economic data coming out of the US. This week's schedule, pulled from investing.com, has reports on manufacturing, industrial production, and the housing market. These numbers are going to give us a fresh look at the health of the US economy, and you could be sure that could influence the Fed's thinking down the road.
So, all of this leaves us with one final thought. We've got central banks that seem to be heading in different directions, we've got geopolitical risks that aren't going away anytime soon, and we have a major currency pair at a historic boiling point. The real question isn't if we're going to see more volatility, but just how wild is it going to get?
This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.